everyone. Welcome to this panel on unsolicited business offers. We're going to have people come in as they shoo them out of the reception area, but so they'll be adding to us as we go. My name is Bill Brown. I'm an attorney in Des Moines, former chair of ABI, and I'll be moderating this panel, so I have the easy job. I get to just ask these guys questions, and hopefully we'll have a little time at the end for some additional questions, but we encourage you to raise any questions you have. And I think we're going to try to keep this fairly informal, so if a question arises during the talk, feel free to raise it at that point. So, and let me just briefly set this up, of course. Businesses across the state get many, numerous unsolicited inquiries about selling a business, and business brokers who have prospects for acquisitions as well. But what we're really going to focus on is those unsolicited offers to buy, what they mean, and what you should do with them. And we're going to go through and ask the panel certain questions and kind of pass it around. I wanted to start with one thing, at least from my perspective, that I'll get into the mix, and that is that anything is always for sale at the right price, and you need to be always prepared for that contingency, because you never know when there's going to be an offer too good to refuse. Hopefully not coming from the mafia, but so one thing I would suggest just to leave this off is that it's always a good idea to do kind of what I call a pre-sale due diligence on yourself. And take a look at your company and make sure that all the pieces and parts are properly documented. One thing that often happens when an acquisition does proceed is that the buyer will uncover things that you may have known about and you didn't think were a problem, and they'll say, well, this is a big problem, and they try to renegotiate the price on this. So it really does matter as you go forward. Sometimes the problems are big enough to prevent a deal from happening altogether, but normally it's a price adjustment sort of situation. So that's just from a lawyer's perspective, looking at this one thing I'd really encourage you to look at on an ongoing basis. So, but with that, what happens? You get, these unsolicited offers in the mail, sometimes multiple ones each week. You're not really interested in selling necessarily, but you're curious as to what is going on. So let me start with you, Steve. What should a business owner's first consideration be when he receives an unsolicited offer or a phone call from someone claiming to either be interested in acquiring them or representing someone who is interested, and also how do they determine if it's really a legitimate inquiry?
Well, the first thing that needs to be done, by the way, I'm Steve Jacobs from BCC Advisors. We're members of the Advisory Council of ABI, proud to be such. I've been in the investment banking business for over 20 years now. I was commercial banker before that, so I've dealt with a lot of different circumstances in a lot of different economic times. And we're in an economic time now where there is lots and lots of capital, low-cost financing, and now that there's a little more certainty in the economy, there's a lot of potential buyers out there. So the real challenge is, what do you do when you get a letter or a phone call or an email? And the first thing that we recommend to clients or prospects is, do you really want to sell? And I heard what Bill said, and I think preparation is the key to knowing the answer to that. But if you're not really very interested in selling, use that as the opportunity to prepare yourself. But don't enter into the discussions unless you're prepared to do so, because selling your business and starting that negotiation process is fraught with a lot of challenges. It can take your eye off of the ball in your business and put you in a very difficult position. So again, the first thing is to decide if you want to sell, because you don't want to invest your time until you're ready to sell. In terms of how do you determine if the interest is legitimate, that depends a great deal on how the contact comes in. If you get a letter, my suggestion is don't do anything with it until you get a follow-up phone call, because there are only 4,000 to 5,000 private equity groups out there that are out there soliciting opportunities for their investors, and they need to put their dollars to use. There are a lot of business brokers out there fishing for leads, and you don't have any idea without questions and more information to know whether or not this is a legitimate offer or it's somebody that's just trying to list your business for sale. So take your time. We always suggest try to keep it out of your office. Contact your CPA, contact your lawyer, contact your business advisor. Let them handle it. Let them try to determine how legitimate it is, because a lot of times when you get a letter, it's so general, you know they haven't even been on your website, let alone they don't know anything about your business. So I think it's critically important that you keep it out of your office so you can maintain confidentiality and let the neutral third party determine if it's realistic by following up and asking questions, and then you can decide very clearly whether it makes sense to proceed or not.
Thank you, Steve. I'm going to direct the next one to Dave Watson, but since I was remiss in introducing people, why don't you give a little bit of your background, Dave, before I ask you the question.
Sure. I'm Dave Watson with LWBJ Financial. We operate basically out of two divisions. One's a CPA firm that does traditional auditing and tax, and the other is a capital advisors division that does a lot of business consulting, where we'll take an idea and help turn it into a business, or we'll take a business and take it clear through a public offering, anything in between. And so that I have the fortunate situation where I have one foot in each division, so I get to do a little of everything.
Okay.
How many feet do you have?
Well, sometimes too many.
Okay, with that background, what is one of the most common accounting issues you see that causes trouble for someone trying to sell their business? What do you need to look at?
Well, LWBJ Capital Advisors is often called on to perform due diligence on companies when one of our clients wants to buy or invest in a company. And one of the things we see more often than we'd expect is that the overall accounting records of a company are inadequate. And you know, you might think, okay, yeah, a little teeny business, they really don't have good accounting records or financials, but we've gone in and looked at companies that are, you know, tens of millions of revenues where their cash management systems call the bank at 4 o'clock and find out how much is in the account. It's really surprising, and these are great companies. And so a lot of times we'll find that situation, and we can't even really tell what our client is buying, or let alone try to put a value on it, because the records are just not good.
All right, and we'll go up to Jim Nally next. Jim, would you give a brief bio of yourself?
Sure. My name is Jim Nally. My background primarily was in public accounting for a number of years. During that time, I got involved with business valuation work, and more recently, over the last 7 years, I've been with BCC Advisors, and my primary role within BCC is to do business valuations. For a lot of cases, it's more for gifting of shares of stock or family limited partnerships for various reasons. We also get into business valuations in divorce settings, other litigated matters. I also am crazy enough to get up and testify as an expert witness on those cases, so I have to do that as part of my job as well. So I've been doing business valuation work for close to 15 years now, and I do a lot of my work really kind of more in a vacuum as opposed to kind of the real world that Steve and these guys might get involved with, more so when the rubber meets the road. Here's exactly what's going to happen at the end of the day when the agreements are signed. So I try to recreate what those conditions are and come up with a valuation based off of those conditions.
Okay. Now, obviously, the thing that's most interest to any business owner is what is my business worth, both to consider whether to sell it and to consider and to evaluate an offer that comes in. So I know you work in this valuation area a lot, and give us a brief overview, if you could, about the definitions, various definitions of the term value, because it really doesn't have just one meaning, and what misconceptions exist as to each.
Absolutely. And that's one of the biggest hurdles that we sometimes have to overcome, is that a business owner might come to us and they'll say, well, I want to have my business value. So, well, the first question is, well, why do you want to have it valued? Do you have an interest? Somebody is looking at buying your company, or are you going to do gifting of shares possibly to a family member, something of that nature? Because value has various meanings. Oftentimes people are familiar with the term fair market value. Well, fair market value has a specific definition. And as a valuation analyst, we have to go by what that definition is. And that is kind of a hypothetical world, which involves a hypothetical seller and a hypothetical buyer. And what's the price that would exchange in cash terms to buy that stock, that interest in the company. And so many people don't understand fair market value as opposed to synergistic value. And synergistic value is pretty much the highest level of valuation that you might have for your company. That's where you're able to extract from the buyer of your company the synergies that they may bring to the table that makes the sum of the parts the whole greater than the sum of the parts. So synergies and synergistic value create a whole different level of valuation. There's also a different term which is really more statutory in nature, and that's fair value. And fair value is defined by the state statutes in place. So sometimes we will get called to provide a valuation based off of fair value. Maybe it's a dissenting shareholder action. Somebody was wronged in the company and they're getting squeezed out. Well, according to Iowa law, they may be due fair value. And in that context, we are not considered discounts for lack of control, lack of marketability, and so forth. So each valuation, the first step is really to figure out, well, what's the purpose, what's your understanding of value, and what are the terms that we're dealing with in that context.
Yeah, let me have a follow-up question for you, Jim, relating to that. Synergistic value. When you talk about synergies, what are the types of things you're looking at, and what are the key elements, and how do they affect value?
Certainly. There's various levels of synergies, and oftentimes if you are approached by a buyer, you won't necessarily know what synergies that buyer might bring to the table. They may be motivated to purchase your company because of the market that you're already in. So they may have a strategic reason to get into your marketplace. And so that's a synergy that the transaction would bring that isn't always known. So the difference between that versus just running your company on a standalone basis may mean more cash flow to the buyer. And so they're willing to pay a little bit more because they know it's going to be more cash flow into their pocket. Another example might be if there's positions that can be eliminated or services that can be eliminated because they're being duplicated. I don't need 2 audits now because I have one big company as opposed to 2 separate companies. So I can eliminate the accounting services. Sorry, Dave. Or I might be able to eliminate a position. We don't need 2 controllers. We don't need 2 marketing people. So you sometimes then can create value by elimination of certain expenses. Those are examples of synergies that a standalone company can't make those changes